Good morning.
Morning.
So the morning we are discussing on the key distinction between the relevant and the irrelevant cash flow, and so that you have to be quite careful because you might end up mixing, or rather presenting the non-cash flow. Okay, so if we are able to distinguish which cash flows are relevant and which cash flows are irrelevant, then your work is going to be quite easy. Because as I had mentioned, okay, the most of the marks that we have in, okay, will be more towards the determination of the total relevant cash flow for each of the year over the life of the investment. To get the NPV, it's really easy. To get IRR, to get the payback, okay, those they already carry like one or maybe 2 marks, two or 3 marks more or less, okay. But all the other marks, maybe 10 or so marks, actually will be more towards determining the cash flows, okay. So as we had mentioned, there are 5 methods we can use when it comes to getting appraise the project. Okay, we say that you can use the discounted and the non-discounted cash flow techniques. Okay, in the case of the non-discounted cash flow techniques, we say you can use 2 methods. We have the use of the payback period method, and you have the use of the accounting rate of return, also referred to as the return on capital employed. In the case of the discounted cash flow techniques, we can use 3 methods. Okay, we can use the use of the discounted payback period. Okay, we can use the net present value method, and we can use the internal rate of return. So more or less, you have in total 5 methods of appraisal. Okay, 5 methods of appraisal. Okay. So you can begin therefore with the first category of appraisal method, okay, the use of the non-discounted cash flow techniques. And we begin with the first method, the use of the payback period. There's the use of payback period. And as just to re-emphasize, okay, as we had mentioned, the key distinction between the discounted and the non-discounted, okay, as even from the term itself, we can tell. And in the case of the discounted cash techniques, don't forget we need to discount all the cash flows. In the case of the discounted cash flow techniques, we need to discount all the cash flows that will be received from the investment. Okay, get their present values. Okay, determine their current values. Okay, then appraise based on their base value. Okay. In the case of the non-discounted, okay, we don't need to do that. Okay, we are going to be using cash flows values as and when we receive them. Okay, without any need for us to get the present value, without the need for us to get their current values. Okay, we don't need to discount those cash flows. Okay, by the use of the non-discounted cash flow techniques. Okay, so let's begin the first method, the use of the payback period. Okay. As I had mentioned earlier on, we said that that the payback period is simply the length of time that it takes, okay, for you as a business, okay, to be able to recoup all the initial investment. Okay, how long do you take from the time that you invest, let's say 10 million? Okay, how long do you take to get back that 10 million from the cash flows that will be generated from the investment? Okay, how long do you take to get back that 10 million? Okay, that's what was the discounted payback period. Okay, how long do you take as a company to get the back all the initial investment that you spent on the investment? Okay, so when it comes therefore to, if for instance we having a project that has a life of, let's say, maybe 2 years, okay, that means therefore you're going to get back the cash you spend on the investment within 2 years. Okay, if the payback is 5 years, that means therefore it is going to take longer, okay, to get back the cash, okay, or your capital investment, okay, because it is maybe 5 years, okay, it is 3 more years than the 2 years period, okay. Therefore, that's on the case of the payback period. Okay, how long do you take as a company to get back all your initial investment? Okay, that part was the payback period. Okay. And generally, in case you have called referred to as, if you have competing projects, okay, you have a number of projects you want to invest the money in, okay, then of course the one that has the shortest payback period is more desirable. Okay, the one that has the shortest payback period is more desirable because you're going to be getting your money a bit earlier than later. Okay, so the shorter the payback period, the more desirable the project is. Okay, so in case they are called if you have what we call projects that are exclusive, okay, that therefore you'd rather invest in that has the shorter payback period, okay. If they are independent, okay, that means therefore one, it does not influence the other, okay, those are independent projects, okay, and then as a company it's worth enough that you do consider what we call a criteria, okay, a benchmark, okay. What's the benchmark payback period, okay? If the benchmark is 3 years, okay, let me just write it down. So if the benchmark is 3 years, okay, this is the target, okay, 3 years, okay, then any project going to have life that is going to have a payback period less than 3 years, okay, is therefore going to be acceptable, okay, between 1 and 0, therefore going to be acceptable, okay. Any project going to have a life or a payback period greater than 3 years, therefore we need to reject it. It is paying, the cash to be paid back, okay, is beyond the 3 year threshold, okay. That's called the use of the payback period, okay. Because you need a benchmark of 3 years, mean therefore a benchmark of 3 years, mean therefore we need to get the cash within 3 years. Okay, that's what a benchmark of 3 years imply. You must get your cash within 3 years. Any period longer than that, therefore makes the project therefore to be a non-desirable project. Okay. Clear. Elvin, it's clear.
Yes, sir.
It's clear. Okay.
Yes, it is.
Okay, let's do an example. And I want you to do this too. First, make the attempt. I think this one, I'll show you how to get the payback for one project. Then I'll ask you to do for Y and for Z. Okay. So assume that you have this investment, okay, that has the following payback. We have, go through it, then we discuss together. So here, this is our cash inflows, not outflow. These are cash inflows. Okay, these are inflows. And this is $1 million, $100 million, and this they are all in $1 million. So this is they are in million of dollars. Take 1 minute to go through them. Okay, let's attempt to do it together. So we told here we need to get a payback period for each of the project, and we determine which one we ought to invest in. So let's begin with X. Then you will do Y and you'll do Z. So let's do X together. So let me just take a screenshot of this question. So the initial investment for X, you've been told is equal to for all of them. X, Y, and Z is 100 million. So therefore, you can have here 0, year 1, year 2, year 3, year 4. Okay, cash flow to be generated. Year 0 is we are simply investing year 0, and invest 100 million is a negative because you are paying. Year 1, you earn that 5. Year 2, that 5. Year 3, that 5, and year 4, that 5. Okay, then the cumulative cash flow. Okay, year 0, because it still remain at 100. Okay, year 1, you earn that 5. Okay, therefore the amount that you remain to recoup is 65. Therefore negative 65. Year 2, you earn that 5. Okay, the amount that they remain, therefore after recouping that 5 is equal to 30. Therefore by year 3, you by end of year 2 you require 30. Okay, in year 3 you earn that 5. That means therefore before year 3 comes to net, you have already been able to recoup all your 100 million. Therefore the payback for this company, therefore between year 2 and year 3, therefore be equal to 2 years. Okay, it's a few months. Okay, by the end of year 2, what you need is 30. Okay, and this 30 million will be earned from that 5 million as per year 3. Okay, therefore 30 out of that 5 million. Okay, that gives the fraction of the year. Okay, 30 million. Don't forget, you're assuming that the cash is generated on a constant basis. Okay, therefore that 5 million is equal to 12 months. Okay, that is equal to 12 months. Okay, that 5 million is equal to 12 months. Well, this is for the entire year. What about 30 million? That's the question you want to answer. What about 30 million? It will be equal to 30 million times 12 divided by 35. Okay, that's what I want to do here. Therefore, we multiply by 12 months in case we want to get into months. And again, therefore, how many years? 2 years and how many months?
10 months and a few days.
Okay, 10 months. So 3 years and 10 months. Okay, simple as that. Therefore, within 2 years and 10 months, the company will be able to recoup back its entire 100 million, its initial investment. Question? Question? Okay, no question. Great. Okay, do Y and Z. So 1 minute, 1 minute. Okay, do Y and Z. Okay, maybe just to make a comment, okay, before you do Y and Z, okay, as you can see in X, we have this is an annuity. An annuity is a constant cash flow earned over constant time period. Equal cash, okay, that 5, that 5, that 5, that 5. So therefore, you can see therefore for X, we have an annuity, an equal cash flow earned over the life of the investment equal to that 5 million. Okay, so if that's the case, therefore we have an annuity is an equal cash flow earned over an equal time period. The payback is quite easy to get, by the way. The payback can also be obtained as the initial investment, initial cost, we divide by the annuity. That is in case, okay, we have an annuity, an equal cash flow earned over an equal time period. That 5, that 5, that 5, that 5 for every year. Therefore, that 5 million, therefore, is an annuity. Therefore, in that case, therefore, the payback would be equal to 100 million. You divide by that 5, okay, and you get 2 years and 100 months.
So this is what the president said.
2.86.
2.86. Okay. If you convert this point into months, you have to get 2 years and 10 months. Okay. That is in case this is an annuity, is an equal cash flow. Okay. And you can't do this for Y and you can't do this for Z because the cash flow for Y and for Z are not annuities. So you can't use this formula. Okay. So you have to use this formula when you're just done here. Okay. Okay, so get the payback for Y and for Z, therefore. Y is 2 years and 6 months. That was very fast. Okay. So 2 years and 6 months. Yes, that's the right answer. Okay. Z.
So you cannot actually
3 years, 3 months.
3 months.
And
Yes, you get 3 years, 3 months to be the payback for Z. Yes, it should be 3 years and 3 months. Anyone who is stuck in getting the payback? Anyone who is stuck? Okay, that is good. If all of you are able to get that, then that is good. And that's therefore we need to answer which one should we invest our money in? Is it X? Is it Y? Is it Z? Definitely the one that has the shortest payback period. In this case, therefore, the project Y. Okay, the firm should invest. Okay, should invest in project Y. Okay, since it has the shortest payback period, okay, payback period. Okay, and that's how you use the payback period method when it comes to the appraisal or when it comes to determining where the company should invest its money in. Okay, very easy, I guess. Elvin, it's clear on your side?
Yes, it is.
Okay, great. So let's see how we have to get there for the use of advantages, disadvantages. I'll leave it to you guys to go through those notes. Okay, advantages. I'll leave it to you to do that. The next appraisal method is called the use of return on capital employed, also referred to as the accounting rate of return. Okay, return on capital employed, also referred to as the accounting rate of return. And here, as I had mentioned also, okay, we say that this is the only method that actually uses profit when it comes to the project analysis, where we want to determine that for every dollar of initial capital that we did invest in the project, okay, for every dollar of initial investment we did invest in the project, okay, how much cash, okay, how much profit has it been able to make for the company? How much profit has it been able to make for the company? Okay, therefore, it's for every dollar of initial investment was a profit, okay, that has been earned by the company. Conventionally, we normally use the word called average basis method. Okay, the average basis method. Okay, we have the formula as it is given there. Okay, let's actually explain a bit further on our notes here. Where we see that the return on capital employed, so the return on capital employed is given us average profit. Average profit, we divide by average investment. And of course, we express this as a percent. We express this as a percent. Where the average profit, okay, where average profit is equal to total profit to be earned over the life of the investment. We divide by the number of years. We divide by the number of years, okay? If the life of the project is 10 years and the total profit to be earned is 100 million, then 100 million divided by 10 to determine what's the average profit per year, okay? Then average investment is given us. Average investment is given us, okay, as the initial investment cost, initial cost of investment, okay, plus scrap value, plus the scrap value. Okay, we divide by 2. Okay, they get therefore the average investment. Okay, it's for every dollar of investment cost. Okay, what's the profit we're earning based on the average profit method, the average investment, the average method as per se. Okay, actually, this is the method that the examiner prefers to use. Okay, as an appraisal click, there's the method your examiner prefers you to use. Okay, to use of the average basis. Okay. However, this formula there are very many derivatives of this formula. Okay, for example, okay, return on capital employed also can be given as, okay, the profit we earned over the life of the investment. Okay, we divide by the initial investment, the initial cost of the investment. Okay, we express as a percent. Okay, that's another way of trying to express the project cost. Okay, the return on capital employed. Okay, rarely is this method used. Okay, so in most of the time the exam will be telling you use the average method basis. Okay, and this is the average method basis. Okay, clear? Okay, and that's how you get there. Therefore, the return on capital employed. As I also mentioned, that here we want to be compared with the benchmark. We compare generally what is the target, okay? What was the benchmark? The company, what profit do they want per dollar of initial investment? If the company has a target, okay, let's say of 30%, okay, return on capital employed, okay, and this investment give us, let's say project A, okay, project A give us, let's say 25%, then we reject it. We reject the project. Why? Because it is yet to achieve the 30% benchmark that it must achieve. Okay. Therefore, in this case, for project A, we don't invest in it. If, however, we have B, okay, to give us 30%, okay, C to give us that same percent, then at point C, you are at point of indifference. Okay. It is just giving you your target. So you can actually invest in it because it is giving you what was your target. And the same applies the case of C, okay, that C is giving us even more than what we actually required, okay. Therefore, C is also acceptable. But if it's going to be below 30%, like in A, then we reject the project. It's here to achieve the target return that the company wanted for every dollar of initial investment the company spent. Clear? Okay, great. So that's on the return on capital employed. This is accounting profit. Okay, this is accounting profit. The normal way you get accounting profit. Okay, therefore, it's the average accounting profit you divide by the average investment. It's actually called accounting rate of return. Okay, so don't confuse with the economic profit. Now I want you to do a question. Since you know how to get the profit, you know how to get the average investment. I want you to do an example here. This question. Let me see how far you can go in this example. Okay, so go through this, then I will check how to get. So in the next 3 minutes, actually, try in the next 3 minutes to get the return on capital employed for this investment. Profit for the entire year is 1750. Okay, so this is profit before. Okay, let me look at the profit before depreciation and tax. This is profit, okay, before depreciation and tax. So therefore, we need to less depreciation, the loss of value of the asset. Okay, therefore depreciation, total depreciation. Okay, for the entire 5 years, 7 years, dog is cost minus the disposal value or the scrap value. We bought this asset at a price of 800. Its disposal value by the end of year 7 is 100,000. Therefore, its loss of value is equal to 700,000. Therefore, less depreciation, 700,000, and we get the profit before tax, okay, to be equal to 1050. And then you pay tax at a rate of 30%. Get how much? 30% of 1050.
315.
315. We have profit after tax. Therefore, for this particular case, therefore, we go to 6,735. Therefore, average profit per year, and therefore total profit, which was 735, divide by 7 years, and get how much? 10?
105.
1005. Okay, you get 1005. Therefore, to be, so these are in thousands. Okay, to get therefore the average profit, average investment. Therefore, initial investment cost, which was 800,000. Okay, plus the disposal value 1,000. You divide by 2, and you get 450,000. Therefore, return on capital employed using the average basis method, therefore, be equal to average profit, which we got to be equal to 105. Average investment, which is 450. You express this as a percent, and you get a much? 20?
29.5%.
29.
25.9, sorry.
25.9%. 25.9%, because therefore, the return on capital employed. Where did you mess it up? Sanya, where did you make a mistake?
So I messed up everything. I
Hey.
didn't do the tax part. I ignored tax.
Hey, okay, no, okay, this is
And also the depreciation part, I kind of messed it up. But I understand now.
Okay, great. Elvin, where did you mess it up?
I didn't include the depreciation.
Okay. Okay, this is the number. Then it's the normal accounting profit. The number we get accounting profit. Okay. And so that's on this particular question. Okay, the use of return on capital employed as a basis of trying to get this. No, I don't know whether I can get a question here.
What's the answer?
Yes.
What's the answer? Can I look at it again, please?
Oh, the answer 25.9%.
Okay, thank you.
Okay. Let's try to look at a question. Where is it? Question bank. We see if they can do maybe. Let's see if they can get a question.
Sorry, sir, just to ask, am I the only one who's getting 23.3%?
I don't know. Maybe I don't know.
Yeah, I got 23.3 as well.
It's 23.3, not 25.
Yeah.
Okay, so 23.3. 23.3. Okay, 23.3%. Okay, fair enough.
So can I look at the depreciation working?
The depreciation, here it is.
Okay, thank you.
Okay. So I'm not sure they can get a question, but let's see. They can get a question. But it's asking us to use most of the time, by the way. Okay. The question will be asked to be more towards the discounted cash flow techniques. Okay. So quite clear, are you going to get a question where they're asking only on the non-discounted cash flow techniques? I think there's one that I saw. Let's see. I think I can do the search. Let's see if I can get payback. Payback. MPV. Yes, we can do this. This is page 80, as per my question bank, page 80. This company is Fence Company, page 80, a company called Fence Company. So you think I do 26, 27, page 80, this company is called Fence Company. Okay, let's attempt to do the payback period, okay, together. Then you try the return on capital employed, see how far you can go. So the payback period for this example, you'll be told that the initial cost is 3.9 million. The amount to be earned year 1, year 2 to year 4, 1.2, 1.5, 1.6, 1.58. Scrap value, okay, year 4 is 100. So you're meant to get how long it takes for the company to get back the 3.9 million. Okay. Therefore, the total cash flow for year 4, okay, we can just have how it's aside working. Year 4 cash flow will be equal to the operating cash flow, okay, plus the disposal value. Don't get this, plus the disposal value, which is equal to 1580. Okay, scrap value plus scrap value to give the total cash flow for year 4 of 100, give that for 1680. Okay. What else? I think that is it. Okay, then you follow our usual table. Okay, so you have year 0, year 1, year 2, year 3, year 4. Here you have cash flow. Year 0 is the initial cost. Okay, the cash flow in thousands for 3.9. Year 1 it's 1200. Year 2 1500. Year 3 1600. And by then I think yes, okay, you don't even need year 4, but either way, can include year 4, which is 1680. Then we have here cumulative cash flow. Okay, year 0, that's 900. We earn 1200, the balance therefore is 2700. We earn 1500, the balance therefore is 1200. That's by the end of year 3, we'll be able to get back our entire 1200, the one we require as at the end of year 2. Therefore, payback, therefore, okay, the payback period, therefore, will be 2 years, okay, plus some few months. Okay, you need to get a decimal. That will therefore be 1200, okay, out of what to be earned in year 3 is 1600 to give us
2.75.
2.75. Okay, then you have the answer here, A. Okay, you can do B, return on capital employed. Okay, so this question being asked, which of the following statement about investor appraisal method is correct? Return on capital employed considers time value of money. It doesn't. We have not done any discounting so far. Okay, well, this is therefore not correct. Okay, therefore this is not correct. Return on capital employed must be greater than the cost of equity. Your project must be. We have not answered them. Okay, we have not done any comparison with cost of equity so far. So therefore that is not correct. The recent project should be rated with a longer payback period. Okay, this seems a bit true to some extent. Let's see. The payback period ignores timing of cash flows within the payback period. It ignores the timing of cash flow within the payback period. Okay, so what that means that, let me just give you an example. Okay, we see whether that's correct. Okay, so let's do an example here. So if, for example, we have two projects here, we have A and you have B, and these are the cash flows. Okay, for A, you get 100 million here. That is this year 1, year 2, year 300 million, 100 million. Here you get 0, 0, you get 300. What's the payback? And if the initial cost is equal to, let's say 3,000. What's the payback for A? What's the payback for A? That's very easy, man.
3 years.
3 years, yes. For B?
3 years.
3 years. Okay, they both have therefore payback of 3 years, 3 years. But is the timing of cash flow the same?
No.
No, very different. Therefore, as you can see, therefore, payback is 3 years for both methods. However, okay, for B, you're going to get the money in the 3rd year. Okay, therefore, this method ignores the timing of cash flow. And that's therefore the D is correct. Okay. Okay, that's on that for your question. Sorry. So let's see.
Sir,
Yes.
could you explain why C is incorrect?
Risk of projects to be rated with the longer payback period. Okay. Now, I'm trying to think of an example I can give. If you're going to be invest. So that let's assume the case of A, B. Okay, assume that you have two projects here. You have A and you have B. I'm trying to think of cash flow to show the riskiness. If you have project A and you have project B, okay, as they are by the way, okay, where the risk of A, which one is more risky here by the way, A or B?
B.
B is more risky. Okay, B is more risky. Okay, B is more risky. Okay, okay, here the risk is actually zero. Okay, in terms of variation of the cash flow from the mean. Okay, okay, here this therefore B is more risky. But now we are trying to tell us that if we have more risky project, okay, like for example, since this one is less risky, we evaluate using 2 years. And since this is more risky, we evaluate using a longer period, assume that we evaluate for 4 years. Is that correct? That in case you have less risky project, use a shorter payback period. If you have more risky project you have like you have in B, we use 4 years. Does that make sense?
No,
No,
I
it
don't
doesn't
get
make
it.
sense. If anything, what should you have? You ought to have a constant, okay? If the company should have a target payback period of generally, for example, 3 years. So it doesn't matter whether it's risky or less risky, okay? That's provided the money is being paid within those 3 years, okay? It doesn't matter. Is it more risky or less risky? Provided you can be getting back money, for example, within 3 years. If the company has that set, that to be the payback period, okay? The payback period ought to be independent of the nature of the project, okay? If you have to use that term, okay? That the target payback period is a target, okay, we should not be paying attention to the nature of the individual project, okay. It should be based that it does not matter whether it's shorter payback period or it's less risky or more risky, provided it pays back money within 3 years, okay. The element of risk here doesn't come in play, okay. The element of risk will come in place in the discounted cash flow method, okay. But it doesn't matter, is it more or less risky, provided it pays the money within 3 years. Okay, so risk is never considered when it comes to the payback period method. Okay, and the same applies even in the case of the payback period method. In the case of return on capital employed, here there is no element of risk. Don't forget this discounting incorporates risk in the appraisal. Okay, but here we have not done any discounting, so therefore there is no element of risk here, as per se. Is that clear?
Yes, yes.
Yeah. Okay. Don't forget, once you discount cash flow at a given rate, it means you are considering risk. Don't forget, by the way. Okay. Once you discount cash flow, it means you are considering risk. Okay, which we don't do when it comes to the non-discounted cash flow methods. Okay. I'm not sure you can answer part question 29. Yes, we can answer actually. Question 29. Yes, can go through it. Elvin, what's the answer?
I think it's one only.
One only. Okay. Nafisa, what's the
Yeah.
answer?
I think it's D.
You think it's B? Okay.
D.
B for boy.
D. Dog.
Oh, D. Okay, okay. Daisy, what's the answer?
I think B as well.
Okay. So, which of the following statement is correct? Majority rewards of which the company should encourage achievement of stakeholders' objective. Of course, A is correct. Okay, so definitely A is correct. So therefore, C is not correct. Okay. Requiring investment project to be rated with the term capital employed is an example of dysfunctional behavior encouraging performance-related pay. Okay. Dysfunctional behavior means that if you're going to, this could be the best term to use here. It could be actually a dysfunctional behavior because as dysfunctional behavior means that it goes against what was like the required, okay, what was the intention of that objective of that particular proposal, okay. So maybe this example, okay, so requiring investment to be based on return on capital employed, okay. Why would the manager want to do that? Maybe because they can have control over the profit, because that's a possibility, okay. Look at the management may involve themselves in creative accounting. Look at the use of return on capital employed is profit based. I think we have mentioned that, okay. Which implies that for if the management, okay, were to want to use return on capital employed, okay, it is within their control, okay, because profit being the numerator is within their control. It could be actually be a dysfunctional behavior, okay, that where the management want to not use less than the NPV, not to use the payback period, maybe because the control there is a bit minimal, okay. However, the use of the return on capital employed is within their reach. So it could be actually be a dysfunctional behavior, okay. And so 1, 2 seem to be correct. Let's see 3. Fence company has an agency problem as data not acting to maximize the wealth of shareholder. If we have a dysfunctional behavior, they're not working to encourage the wealth of the shareholders, then they seem not to be correct. Because 2 and 3 are tied together. 2 and 3 are tied together, okay? Because if there's dysfunctional behavior, then to which the managers are acting for their own interest, not the interest of shareholders. Okay, seem therefore we have an answer there. D. Clear?
I have a question.
Yes, Brian.
The question says that the directors have decided to invest in a project. It's only that they're going against shareholders' wishes to use net present value. So in terms of giving return to the shareholders, there is a project that has been invested in. It's just that they're not using a preferred method. So I'm not sure whether that's an agency problem, because I don't think it is.
The managers are not using the preferred method. Okay. Now, let's tie down 2 and 3. Okay. Let's tie 2 and 3. If the managers are pursuing, they're pursuing an interest which is not the interest of shareholders. For example, they're using return on capital employed as the appraisal method, okay, because this appraisal method is within their control. Is that good or bad?
Well, the choice says shareholder wealth. So there's, because also for NPV, aren't the directors in charge of the projected profits?
No, don't forget, for the case of the NPV, we are using cash flows. It's money in and out of the business. So therefore, the managers per se, they can't be able to manipulate the books, the cash, because it's about cash. Is money in, there's a money in, there's a money out. But the use of profit, the manager can manipulate. Why? They can decide we are going to be depreciating not over 10 years, but over 30 years. Isn't it?
Yeah.
Therefore, reducing the expenses, increasing the profit. They can't do that with the case of cash flows. Okay, cash flows are more beyond, like in quote, beyond their control. because simply going to determine what's the money into the business, what's the money out of the business. So as per se, the managers per se, they don't have control, but they cannot be able to manipulate cash as opposed to the way they can be able to manipulate the profit. I don't know whether you're getting my point.
Yes.
Because the managers are the one who decide on the accounting policy, the principles sometimes, okay? We are going to proceed over 10 years, or 30 years, or 40 years. However, this is not going to be affecting the cash flows of the company. Clear there, Brian.
Yes, so is using NPV
It's a better
guaranteed to increase shareholder wealth?
No, it's not going to be guaranteed, but at least it's going to do away with one of the problem. Okay, the problem where the managers can manipulate what is going to be the NPV. They can't do that now this time around. Okay, but however, they can manipulate what is going to be the return on capital employed. They can do that. They can say that if, for example, assume that the books are presented a true and a fair view, okay, and the company the return is let's say 20%, okay, they can decide we need to increase this from 20 to 30%. They can do that, okay, by simply going to try to go revise the book values, revise maybe depreciation, revise the provision for bad and out of debt, okay, so they can have control over this value. However, they can have no control on the NPV because simply is money into the business, money out of the business. They have no control in that angle. If the NPV is 10,000, they can't go and try to doctor the books to appear as if the NPV is more than this. Both is the money into the business. So it can be asked, where is this money? Okay. You say that you have a cash flow of 10,000. Would we have it in the bank right now? Okay. If you have to go revise, trying to go through the bank statement, can we see that in year one from this project alone, we got this much? Okay. So it's easier to track. For the case of the accounting profit, okay, it's a bit hard because it is within the manual decision to decide a number of things which may affect the value, the return on capital employed. Do you get it, Brian? I hope we get to the point.
Yes.
If not, don't forget. It's clear.
It's clear.
Okay. So
Answer?
Yes.
So if the managers prefer NPV, so is true correct or not? Is it a dysfunctional behavior?
If the managers prefer the NPV,
yeah.
No, it's not. It might not because they may not have. I don't think it's an encouragement of dysfunctional behavior because they don't have control over the NPV. So if anything, that's a good proposal for flow. If it is a manager who are proposing that method, so I don't think this is a dysfunctional behavior. So this dysfunctional behavior is acting not in the interest of the shareholders, but you are trying to act on your own interest. So the proposed method you want to use, okay, it simply is, however, it is there to serve your own interest. Okay, for the NPV, since the managers have no control over what will be the NPV value, then as per se, therefore, they may not be able to. It's a good proposal, it's a good move because it is beyond the individual control. Clear, Sakina?
Okay. Yes.
Okay, good. Okay. 30. Can do that. Nafisa, what's the answer?
I think D, but I'm not yet sure about it.
D.
Yeah.
Okay, Elvin.
I'm not.
Sorry, Elvin.
I'm not sure.
You have to pick an answer. This is an exam. But then the exam never leave in a question unanswered, especially the multiple choice question. You can't leave in a question unanswered. Okay, you do that. Take the chance. In Elvin, back to you. You have to take. You have to take. You can't leave it unanswered.
Give me a chance to go through it again.
Yeah. Okay. Daisy, what's the answer?
I selected C.
C. Okay, C. That is. Sakina.
C for me as well.
Sanya.
So I think A.
A. Two only. Okay, let's do it together. Now here. When it comes to the pay, okay, who designed the pay to the directors? Because I think you're down a bit of
Remuneration committee.
remuneration committee, but which is a part of the board of directors. Okay, it is the remuneration committee, which is a part of the board of directors, not the senior executive. Okay, not the senior executive. It is the remuneration committee. Therefore, any that has one is wrong. Therefore, B and D are out. Okay, don't get the pay to the directors is determined by remuneration committee, which is a committee of the board of directors. So therefore, B and D are out. Anyway, so introducing share option schemes would help the directors bring the directors' objective in line with shareholders' objective. Yeah, it looks okay. Because definitely you want to make them become as if they're part of they're part of the shareholders. Okay, so if they had you as shareholder, they had themselves. Okay, so in a way, therefore, paying them or give them share options make them become co-owners of the business, which is therefore correct. Okay, linking the financial rewards. Sorry.
Could you please explain what share options scheme was?
A share option scheme. This way, you sort of you give the managers that hey, in 3 years' time, okay, you can buy my share. You can buy our shares, okay, at a given price. Okay, so you are giving them an option that hey, in 3 years' time, that is in 2023, okay, you can buy the shares of our company at a given price. Let's say it's $10. Okay. Now, if currently in the year 2020, the share price is let's say $10, okay, it implies therefore if the managers increase the share price, okay, from $10 to let's say to that $5 by the time we are in year 2023, they'll buy the share not at that 5, okay, but at 10. Therefore, as they pursue, okay, if they buy them at 10, then don't forget they get a value of 25, the difference, okay, because is that 5 minus 10, the price they buy the shares at, okay. Therefore, their gain is the difference in this case 25. How do they maximize the gain? By maximizing the share price, maybe from that 5. If the share price is even greater than that 5, or maybe for example it's 50, okay, for example it's 50, then their gain therefore will be 10 minus 50, which is therefore give it to 40. So as they pursue to maximize their gain from the option you have given them, they are maximizing your wealth as shareholder through the share price. Okay.
When do they buy the shares, in like 2020 or 2023?
No, 2023. They buy the share in 2023. Oh. Yes, in 2023. Not today, but 2023.
Thank you.
Linking financial rewards to target return on capital employed will encourage short-term profitability, okay, and discourage capital investment. Of course, it will. Okay, don't forget we have said that return on capital employed is determined by the profit. So it may end up having you pursue more of profit orientation as opposed to the shareholders with maximization. It's true. Because definitely you want. Don't forget how do you maximize the return to capital employed? By investing in projects that have more profit. Clear? Therefore, 2, 3. So which is C, therefore? Answer is C. Okay, actually, this is one of the dysfunctional behavior. Okay, I think that we are trying to attempt to mention a bit earlier. Okay, these are dysfunctional behavior. Okay, this is topic 1. I think this was topic 1. Any questions so far? Okay, no question. Great then. The next appraisal method, okay, is the use of the discounted cash flow techniques. Okay, the discounted cash flow techniques. Okay, which I don't think I want to start off. But just to just to be on the same page, we agreed we're going to have our cut this Friday, isn't it?
Yes.